When a life insurance agent is involved in creating an annuity contract, they must prepare the contract with great care. The investor needs to comprehend the restrictions before completing the purchase, particularly for a payout annuity, due to the commitment and restrictions involved. The agent must ensure the investor fully understands what to expect and what they will receive. Many of the principles of an annuity contract are similar to those of an individual variable insurance contract, IVIC, including the need for the agent to be detail-oriented and professional throughout the entire process, from application to delivery, and through ongoing service and claims. Contract. Life annuities and term annuities sold by insurers are considered insurance policies, which are contracts that establish a legal relationship between the client and the insurer. While some terms, known as general contract provisions, can apply to all policies, other terms are specific to the type of policy issued. Payout and accumulation annuities differ significantly in structure and purpose, and their contracts will also vary. A payout annuity contract represents a commitment for a specific term or life and is final once issued. The only change that can be made is to the beneficiary's name. A life annuity contract does not have an escape clause. The investor cannot cancel the contract to get a refund of their investment. The annuity rate applied to the premium remains in effect for the duration of the annuity. For an immediate annuity, a quoted annuity rate used in an illustration might be guaranteed by the insurer for a certain period. If there is no guarantee, the income is calculated using the annuity rate in effect on the date the premium is received. The payout annuity application specifies that income payments are based on the annuity rate, the type of annuity, and the payment frequency selected by the investor. The contract itself confirms this information. An accumulation annuity contract contains provisions that apply both before and on or after the maturity date. These provisions cover how interest is calculated and paid, minimum and maximum withdrawal limits, and how the contract can be terminated. Amendments and addendums can be attached to a contract to customize it for an individual's specific situation or needs. An amendment can be used to waive a contract provision or to correct an error or omission. For an amendment to be valid, it must be prepared in writing by the insurer and signed by the investor. As with all insurance product applications, the agent must make sure all information provided to the insurer is accurate so the contract can be prepared correctly. The agent should be able to answer all investor questions clearly and factually. If an agent is uncertain about any part of the future contract, they should contact their manager, supervisor, or the insurer for clarification. By addressing questions as they come up, the agent builds a strong understanding of the product, which is useful for future client interactions. This solid product knowledge, combined with an understanding of investor needs, enables the agent to provide excellent service. Investor requirements. The investor has two main requirements for both payout and accumulation annuity contracts: assisting the agent by providing all necessary information for the application and funding the contract. Each type of contract also has specific requirements. A payout annuity contract requires the investor to select a payment schedule and provide details for the financial institution and account where payments will be made. An accumulation annuity contract requires the owner to make choices regarding its investment term. Application form. Application forms for annuities vary significantly between insurers. Some applications are multi-page documents that include all necessary information, while others are shorter but require the agent to complete and attach additional forms to make them complete. The wording of applications also differs widely, with each insurer using product-specific language. Applications often include definitions of terms that the agent should review with the investor to ensure mutual understanding. Like the IVIC for segregated funds, the annuity application is completed jointly by the agent and the investor, either in person or virtually. The application may be available online or in a printed format. The investor must provide accurate and truthful information. The investor, not the agent, decides which annuity product to choose. The application process should not be rushed. The agent must manage their time to complete the application with the investor in one sitting and should never take a partially completed form to finish on their own. Every application form must be carefully reviewed before, during, and after the meeting with the investor to ensure accuracy before submission. If a mistake is made on a printed application, a change can be made, and both the investor and the agent must initial the change as close to the corrected information as possible to show their agreement. Changes to an online application can be made before submission by simply deleting and re-entering the correct information. Therefore, online applications must be reviewed with great attention to detail before electronic submission. An agent should never assume the application is correct. They must verify all information, including the spelling of names and data from documents like a birth certificate. Similar to an IVIC, an annuity application may be completed by a person with power of attorney, POA, for the property of another. Legal guidance is necessary if the POA decides to name a beneficiary. Neither the agent nor the investor is allowed to modify, cancel, or waive any question on the application, as doing so could void it. An application is not final until the insurer accepts it. A reason why letter is prepared and reviewed with the client when the application is submitted, similar to an application for a segregated fund. This letter, which must be easy to understand and brief, paraphrases what the agent learned from the client, confirms what was discussed, and outlines the plan of action. After reviewing the letter for accuracy, the agent should give a copy to the client and keep one for the client's file. Registered or non-registered annuity. A contract can be issued for a registered or non-registered annuity. For a registered annuity, the contract owner and the annuitant must be the same person. A registered contract is subject to all Income Tax Act, ITA, rules for registered accounts, including the age at which income can be paid from the account, the requirement for a minimum withdrawal, withholding tax on withdrawals, what happens to the account if the owner dies. All withdrawals from registered accounts must be declared for tax purposes in the year they are made. A non-registered account is not subject to Canada Revenue Agency, CRA, rules for contributions, withdrawals, or tax deferral. However, it is subject to the rules set by the insurer. A non-registered annuity may be taxed in a prescribed or accrual non-prescribed form. While the prescribed form is preferred because the interest component of each payment is level, it must meet several criteria. Naming annuitant and beneficiary. This is a straightforward part of the application where the owner names their choice for the annuitant and, if applicable, a primary and contingent beneficiary. The agent should note the following. The owner and annuitant must be the same person if the annuity is registered or funded with registered savings. In a joint annuity, two annuitants must be named, the annuitant and the joint or co-annuitant. The joint annuitant becomes the sole annuitant upon the death of the first. The beneficiary receives no proceeds until the death of the second joint annuitant, and only if the contract has a guarantee period. A beneficiary must be named if there is a guarantee period. A beneficiary cannot be named or added later to a life annuity with no guarantee period. If the premium comes from a locked-in pension, the death benefit may be payable to the spouse instead of the beneficiary. In this case, the spouse's information must be provided unless they have waived their rights to the benefit in a spousal waiver form. As with all insurance contracts, a beneficiary can be designated as revocable or irrevocable. The owner must understand the restrictions that apply when an irrevocable beneficiary is named, primarily the inability to change the beneficiary without their consent. A contingent beneficiary can also be named. They become the beneficiary if the primary beneficiary dies before the annuitant. A contingent beneficiary is always revocable. Owner identification. Identification requirements for annuity contract owners are the same as those for segregated funds, following the Proceeds of Crime, Money Laundering, and Terrorist Financing Act. There are two exceptions to these identification requirements. When an immediate or deferred annuity is funded by a transfer from a registered pension plan or the proceeds of a group life insurance policy. When the contract is registered. The owner of an annuity contract must also provide evidence of the age of each annuitant. If the owner is a legal entity, its identity must be confirmed with specific documentation. Funding the contract. Funding for an annuity contract can take two main forms: a new cash deposit or a transfer of existing savings. Sources of funds can include direct deposits from accounts and transfers from both registered and non-registered savings, such as personal savings or checking accounts, bonds, guaranteed investment certificates, GICs, tax-free savings accounts, TFSAs, stocks, mutual funds, and segregated funds. Registered Retirement Savings Plan, RRSP. Registered Pension Plan, RPP, contributions to a defined contribution pension plan, DCPP, or a recognized participation amount from a defined benefit pension plan, DBPP. Registered Retirement Income Fund, RRIF. Locked-in Retirement Account, LIRA. Life Income Fund, LIF, or Locked-in Retirement Income Fund, LRIF. Deferred Profit Sharing Plan, DPSP. Prescribed Retirement Income Fund, PRIF. Restricted Life Income Fund, RLIF. After the contract is delivered, an agent should provide ongoing service to ensure changes are accommodated and to identify other product sales opportunities. An excellent service opportunity exists for agents with clients whose RRSPs are maturing, whether they are held at the same or other financial institutions. One option for RRSP owners is to convert the value of their plan at maturity to a term, to age 90 annuity or a life annuity to continue tax deferral. If an annuity is a suitable choice based on a needs analysis, the agent provides a valuable service by presenting this option. A client may have multiple maturing RRSPs. Converting one to an annuity and another to an RRIF can be the best solution for continued tax deferral. Although annuities have become less popular than RIFs, they remain a valuable maturity option because they offer a dependable source of guaranteed income without the need for account management or ongoing decision-making. Contract delivery. Annuity contracts are not always delivered in person by the agent. The insurer may mail or courier the contract to the owner. However, if it is possible and safe, an in-person delivery allows the agent to reinforce the value of the product and answer any additional questions. Ongoing service requirements. For an agent, servicing an annuity contract involves ensuring the beneficiary designation aligns with the owner's wishes. For an accumulation annuity, service also includes handling deposits and managing contract maturity to determine if conversion to a payout annuity is appropriate. Change of beneficiary. A beneficiary can be replaced if the owner changes their mind or if the named beneficiary has died. The owner can name any beneficiary they wish, provided the beneficiary is revocable and there are no restrictions due to the contract being funded by locked-in funds from a registered pension plan. To make a change, the owner completes and signs a change of beneficiary form, which revokes all previous designations. The completed form must be sent to the insurer immediately. Handling deposits. Agents may receive deposits in the form of cash, a check, or a bank draft. All deposits must be handled securely and sent to the insurer promptly. Cash deposits may be subject to anti-money laundering legislation under the Proceeds of Crime, Money Laundering, and Terrorist Financing Act. The agent must be familiar with and strictly follow these rules to ensure compliance. A receipt should be provided to the client for any cash deposit received. Checks and bank drafts must be made payable to the insurer, and if a policy number has been assigned, it should be included on the check. The agent must take every precaution to prevent deposits from being stolen or lost, such as by never leaving them in an unoccupied vehicle and storing them under lock and key in the office. Claims. A claim is a request to receive some or all of the funds held in a contract, and the person making the claim is the claimant. An agent can assist the claimant with the process. A properly submitted claim with all necessary attachments will be processed more quickly. Claims process. The agent can provide the claim form or information on how to get it, what documentation is needed, and where to send the completed form. Processing begins once a completed form with the claimant's signature is received. While the agent can help with preparation, a claims representative at the insurer takes over once the claim is submitted, and the agent is no longer involved. The representative issues checks or transfers funds as requested. Types of claims. A claim can be made on a payout or accumulation annuity upon the annuitant's death if a beneficiary is entitled to the proceeds. The contract owner can also make a claim for a withdrawal or surrender of a term or accumulation annuity. Death claims. If the primary beneficiary dies before the annuitant, a contingent beneficiary may receive the proceeds. If there is no living beneficiary, the annuitant's estate makes the claim, and the proceeds are paid to the estate. In provinces with probate fees, these fees would apply as the proceeds become part of the estate's value. However, probate fees do not apply when a named beneficiary receives the proceeds of the contract. A joint and last survivor annuity contract names both a primary annuitant and a co-annuitant. The primary annuitant receives payments for their lifetime, and upon their death, the second annuitant receives payments for their life. The switch is initiated by providing proof of the primary annuitant's death to the insurer. Surrender and withdrawal claims. An accumulation annuity offers flexibility that a payout annuity does not, permitting withdrawals within minimum and maximum limits and surrender. If an accumulation annuity is cashed in before its maturity date, the insurer may apply a market value adjustment (MVA), which reduces the amount the owner receives. The MVA amount depends on the remaining term, the interest rate at the time of investment, the current interest rate, and fees. An accumulation annuity can be surrendered at any time. A term annuity can also be surrendered, but a penalty will be charged according to the contract terms. A life annuity cannot be surrendered once payments have begun. Any claim for surrender or withdrawal must be made using a form acceptable to the insurer. Power of attorney (POA) claims. A person acting as a POA for property may need to complete a special form for third-party claims on the account. The insurer will provide the appropriate form. Factors affecting claims. When applicable, Taxes are always withheld by the insurer according to the ITA when a contract is surrendered or a withdrawal is made. The amount received and how it is paid depends on whether a cash or installment refund was chosen to protect the annuity capital for the beneficiary and whether a guarantee period is in place. A claim cannot be made against a life annuity unless a guarantee exists. The beneficiary is entitled to the portion of the contract not yet paid to the annuitant, which represents the payments remaining in the guarantee period or the difference between the initial capital invested and the payments made until the annuitant's death. The beneficiary has no further claim after the guarantee period ends.